What is happening in the crypto world right now? We're diving deep into the biggest stories that you absolutely cannot miss. From the epic showdown between digital titans to a surge in unexpected activity, buckle up because this is Bitcoin Bulletin, and we're bringing you the unmissable updates you need to stay ahead of the curve. Get ready for a high-octane journey through the latest in finance, tech, and innovation. The market is moving at lightning speed, and you need to be in the know. Let's get into it. First up, the ultimate battle of the digital age, Bitcoin versus Ethereum. These aren't just two cryptocurrencies, they're the pillars of the decentralized revolution, each with its own unique strengths and ambitions. We're breaking down what makes them tick, how they differ, and why this rivalry matters for the future of finance. Are you on Team Bitcoin or Team Ethereum? Or maybe you're hedging your bets on both. We've got the inside scoop on their core technologies, their distinct approaches to value, and the innovative paths they're forging. Prepare to have your mind expanded as we dissect the DNA of the two biggest players in the crypto arena. Next, we're shifting gears to a critical alert. Bitcoin's record highs are attracting a dark side. As the value skyrockets, so do the schemes of digital predators. We're talking about sophisticated scams designed to trick even the savviest users. From deepfakes and cloned websites to social media manipulation, the landscape is more treacherous than ever. We'll expose the tactics being used, highlight the platforms where these threats are most prevalent, and give you the essential knowledge to protect your hard-earned assets. Don't let your crypto dreams turn into a nightmare. Stay informed, stay vigilant. Then, we tackle a fascinating paradox in the world of retirement planning. California's massive pension fund, CalPERS, is facing a monumental decision. Should they dive headfirst into Bitcoin? The debate is fierce, with board candidates presenting wildly different visions for the future. Some see Bitcoin as a crucial store of value for long-term stability, while others warn of its inherent volatility. We're exploring the arguments for and against direct investment, the implications of their current indirect holdings, and what this massive pension fund's choice could mean for the broader adoption of digital assets in traditional finance. It's a battle of old guard versus new frontiers. And finally, we're circling back to California for another angle on this pension puzzle. With so much at stake, what are the real-world impacts of these investment decisions? We'll look at how other state funds are navigating the crypto waters, the growing institutional interest, and the key factors influencing these massive financial institutions. It's a deep dive into the future of your retirement savings and the evolving role of digital currencies in the global economy. You won't want to miss this. Stick around because this is Bitcoin Bulletin, and we're bringing you all the crucial insights. Don't forget to smash that like button, subscribe if you haven't already, and ring that notification bell so you never miss an update. The digital gold versus the internet's future. Bitcoin versus Ethereum. Bitcoin and Ethereum stand as the undisputed titans of the cryptocurrency realm, their very names synonymous with the digital asset revolution. While both operate on the foundational technology of blockchain, offering decentralization and a departure from traditional financial systems, their core philosophies and functionalities diverge significantly. Bitcoin, often lauded as digital gold, is primarily designed as a store of value and a medium of exchange. Its scarcity, enforced by a fixed supply of 21 million coins and the periodic halving events that reduce miner rewards, underpins its appeal to investors seeking a hedge against inflation and a reliable asset for long-term holding. The network's proof-of-work consensus mechanism, while robust and secure, is notoriously energy-intensive, a point of contention regarding its environmental impact. Ethereum, on the other hand, was conceived with a more ambitious vision: to become a decentralized platform for a new generation of the internet. Its co-founder, Vitalik Buterin, envisioned a system where smart contracts, self-executing agreements written in code, could power decentralized applications, dApps. This innovative approach has made Ethereum the backbone of decentralized finance, DeFi, non-fungible tokens, NFTs, and a vast ecosystem of applications that operate without central intermediaries. Ethereum's recent transition to a proof-of-stake consensus mechanism has significantly reduced its energy consumption, making it a more environmentally friendly alternative. Furthermore, Ethereum's flexibility allows for the creation of various token standards, such as ERC-20, which facilitates the launch of new digital assets with diverse functionalities, unlike Bitcoin's more limited token issuance capabilities via its Omni layer. The differences extend to their operational mechanics. Bitcoin blocks are typically confirmed every 10 minutes, ensuring a steady but slower transaction process. Ethereum, with its proof-of-stake model and optimized network, achieves much faster block confirmations, often within 15 seconds, enabling quicker transaction settlements. Even their public wallet addresses have distinct formats, with Bitcoin addresses often starting with 1, 3, or BC1, while Ethereum addresses commonly begin with 0x. These technical distinctions, coupled with their differing developmental roadmaps and community focuses, highlight their unique positions in the crypto landscape. Bitcoin solidifies its role as a digital store of value, akin to a digital reserve asset, while Ethereum pioneers the infrastructure for a decentralized digital future, powering innovation across numerous sectors. But as these digital giants continue to evolve, a more concerning trend is emerging in the shadows of their success. What happens when unprecedented growth attracts unprecedented threats? Record highs, record scams, navigating the new crypto threat landscape. The meteoric rise of Bitcoin, propelling it to record highs and capturing mainstream attention, has unfortunately created a fertile ground for malicious actors. As the cryptocurrency's popularity surges, fueled by institutional adoption and high-profile endorsements, cybercriminals are adapting their tactics to exploit this renewed interest. This environment has led to a significant uptick in sophisticated scams targeting both individual users and businesses, making vigilance more critical than ever. Cloudflare's research highlights how cyber threats are evolving in lockstep with crypto's growing prominence. Scammers are adept at capitalizing on trending moments, such as celebrity endorsements or significant market movements, to launch convincing schemes. A favored tactic involves impersonating public figures or influential personalities, including political figures, to conduct elaborate phishing attempts. Victims might receive emails or messages promoting fake giveaways or exclusive NFT projects, designed to trick them into divulging sensitive personal information or cryptocurrency wallet credentials. These phishing campaigns are becoming increasingly sophisticated, meticulously mimicking the branding of trusted platforms like Ledger or Binance, and often employing a sense of urgency to pressure users into acting rashly. Social media platforms, where users spend a considerable amount of time, have become a primary vector for spreading these fraudulent schemes. Platforms like X, formerly Twitter, Telegram, and TikTok are being exploited to amplify deceptive crypto content with alarming speed and reach. On X and Telegram, scammers frequently impersonate prominent crypto personalities or companies, offering fake giveaways or investment opportunities that require users to send cryptocurrency for verification purposes, promising amplified returns. These messages are often boosted by bots and engagement bait to create an illusion of legitimacy. TikTok's viral nature and fast-paced video format have made it a breeding ground for misleading crypto promotions, with influencers sometimes unknowingly promoting dubious tokens or pump-and-dump schemes. The platform's short-form content can make it difficult for viewers to verify claims or identify red flags before making impulsive decisions. The danger is amplified by the increasing sophistication of these scams, which now leverage tools like AI-generated deepfakes and cloned websites to create highly believable, often undetectable, fraudulent operations. Some attackers even employ geofencing techniques to limit the visibility of their scam sites to specific regions, further evading detection. The financial repercussions are substantial, with billions lost annually to various crypto scams, including phony investment platforms, tech support impersonations, and romance-based fraud. Wallet-draining tools, often embedded in fake browser extensions or counterfeit interfaces, represent a particularly dangerous threat, as victims are tricked into approving transactions that drain their funds irreversibly. While high-tech methods are prevalent, traditional tactics like phone calls and text messages often impersonating crypto support teams, remain effective. These scams are enhanced by AI, making victims believe their accounts are compromised and requiring immediate action, leading them to reveal credentials or send funds to scammer-controlled wallets. Fake cloud mining services also continue to lure users with promises of effortless income, often designed solely to collect data and steal funds. The irreversible nature of cryptocurrency transactions means that once funds are compromised, recovery is virtually impossible, underscoring the paramount importance of user vigilance, robust security practices like two-factor authentication, and the use of hardware wallets. As the digital landscape becomes more perilous, a different kind of challenge is emerging within the traditional financial world. Can established institutions adapt to the new digital paradigm? The pension paradox. California's $506 billion fund debates Bitcoin's place. California's colossal public employees retirement system, CalPERS, managing a staggering $506 billion in assets, finds itself at a critical juncture, deeply divided over the prospect of direct Bitcoin investment. The ongoing debate, starkly highlighted during a recent forum featuring candidates vying for board seats, reveals a fundamental schism in how institutional finance should approach the burgeoning digital asset class. While CalPERS already holds a substantial indirect exposure to Bitcoin through its significant investment in MicroStrategy, now known as Strategy, a company holding vast amounts of Bitcoin, the question of whether to embrace direct custody remains a contentious issue. The forum underscored the ideological divide among the candidates. Incumbent board member David Miller voiced strong opposition to cryptocurrency inclusion, stating unequivocally that cryptocurrency should not have a seat on our board and never should. This stance drew immediate criticism from challenger Dominic Bay, who questioned the logic of maintaining indirect exposure via MicroStrategy while outright rejecting direct investment. Bay argued that CalPERS, by holding shares in a company whose primary asset is Bitcoin, is already exposed, and that direct investment would offer more control and potentially better alignment with the fund's fiduciary duties. Challenger Steve Mermel dismissed cryptocurrencies entirely, drawing parallels to past financial failures like Enron and labeling the asset class as opaque and unsuitable for a pension fund. In contrast, Cadden Stadelman, Chief Technology Officer at Komodo Platform, presented a compelling case for Bitcoin's inclusion, particularly its role as a store of value. He asserted that Bitcoin's characteristics make it well-suited for long-term institutional portfolios, and that CalPERS has a duty to explore direct holdings rather than relying solely on intermediaries like MicroStrategy. Stadelman also addressed concerns about volatility, suggesting that in the context of persistent inflation, Bitcoin's price fluctuations are manageable, especially for a fund with a long-term horizon. Challenger Troy Johnson adopted a more measured approach, acknowledging the inherent volatility of crypto assets, but declining to close the door on future consideration, emphasizing the need for a balance between innovation and rigorous risk management. This internal debate within CalPERS mirrors a broader trend of cautious exploration and growing interest in Bitcoin among institutional investors. Recent filings indicate that other state pension funds, such as Michigan's State Pension, have significantly increased their exposure to Bitcoin ETFs, tripling their holdings in the second quarter. Similarly, Wisconsin's Investment Board maintains substantial holdings in Bitcoin ETFs, and Florida's retirement system continues to hold a significant number of MicroStrategy shares. These moves suggest a growing recognition of Bitcoin's potential role in diversified institutional portfolios, not just as a speculative asset, but as a potential hedge against macroeconomic uncertainties and currency devaluation. The upcoming November election for the CalPERS board seats will be pivotal, with the outcome potentially shaping the fund's future approach to digital assets and influencing similar discussions at other major pension funds across the nation. As institutional giants grapple with the digital frontier, the underlying technology continues its relentless march forward. What new records is the network itself setting? Beyond the debate, Bitcoin's network strength and evolving institutional embrace. While the high-profile discussions surrounding Bitcoin's potential role in massive pension funds like CalPERS highlight the ongoing debate about its place in traditional finance, the underlying Bitcoin network itself continues to demonstrate remarkable resilience and growth. These internal institutional debates often focus on perceived risks like volatility and regulatory uncertainty, yet they occur against a backdrop of significant network advancements and increasing institutional adoption, painting a more complex picture of Bitcoin's evolving role. CalPERS internal deliberation, as evidenced by the starkly contrasting views of its board candidates, reflects a broader tension between established financial prudence and the embrace of new, potentially disruptive asset classes. The fund's current indirect exposure via MicroStrategy shares, valued at $165.9 million as of its Q2 13F filing, demonstrates a clear recognition of Bitcoin's market significance. However, the resistance to direct custody, voiced by candidates like David Miller and Steve Mermel, stems from concerns over volatility, security, and the fiduciary responsibilities associated with managing retirement assets. Conversely, proponents like Cadden Stadelman argue that Bitcoin's properties as a store of value and a hedge against inflation make it a compelling asset for long-term portfolios, urging a move towards direct, self-custodied holdings to fully capture its benefits. This internal CalPERS debate is set against a backdrop of increasing institutional embrace and network strength. Reports indicate a growing interest from UK pension firms in Bitcoin exposure, and the Michigan State Pension's decision to triple its Bitcoin ETF holdings to $11.4 million in Q2 signals a tangible shift. These institutional inflows are crucial as they provide validation and liquidity to the market. Simultaneously, the Bitcoin network itself is hitting new milestones. The hash rate, a measure of the computational power securing the network, recently reached a record high of 1.279 zettahashes per second. This surge in hash rate indicates robust miner participation and reaffirms the network's security and decentralization, even amidst fluctuating market prices and ongoing regulatory scrutiny. The efficiency and adaptability of miners, who invest heavily in hardware and electricity to validate transactions, are key to maintaining this network integrity. While critics often point to Bitcoin's volatility as a primary deterrent for conservative institutional investors, proponents argue that this volatility is precisely what makes it an attractive hedge against inflation and currency debasement, particularly in times of macroeconomic uncertainty. The narrative around Bitcoin is shifting from a purely speculative asset to one with potential long-term value preservation characteristics. The decisions made by large pension funds like CalPERS will have a ripple effect, influencing investment strategies and perceptions of digital assets across the entire financial industry. As the November elections approach, the outcome for CalPERS could set a precedent, either reinforcing traditional caution or signaling a more aggressive embrace of Bitcoin within public pension systems. From the boardrooms of California to the digital frontiers of the market, the pace of change is relentless. What does all this mean for you, and what's next? All right, everyone, let's do a super quick recap. Bitcoin and Ethereum are going head-to-head, each carving out its unique niche in the digital world. But beware, as Bitcoin hits new highs, scammers are getting smarter, so stay vigilant. And in California, a massive pension fund is wrestling with whether to dive into Bitcoin, showing how the traditional finance world is slowly adapting. It's a wild ride out there. That's all the essential intel for today. If you found this breakdown valuable, please give this video a massive thumbs up, subscribe to Bitcoin Bulletin for all your crypto news needs, and hit that notification bell so you never miss an update. Ring it loud. And don't forget to follow us on all our social channels to keep the conversation going. We'll see you in the next one.